Good afternoon, everybody, and welcome to the first of the Skybound Financial Planning, Investment, Market and Economic Outlook webinars. The plan is to have these webinars every 6 months or so. So the next one will be in late March, early April. Skybound Financial Planning has been part of the wider Skybound group since July 2020. The group is not huge. It's about 3 or 4 times our size, which means that we've been able to maintain the personal level of advice that our clients have been receiving. The advantage to the group is that we have access to a greater level of resource, both commercially and on the investment front. And this resource is provided primarily through the Skybound offices in Cape Town, Hong Kong and London. Skybound have had a London office since I think 2008, and it received FCA authorization in 2011. Now at Skybound Financial Planning, we've been offering investment recommendations to our clients since 2009. And this has been through the Investment Management Committee based in Poole. And now that we have access to the greater level of research from the Skybound Group offices, we're looking to improve the consistency of our clients' returns, and at the end of the day, increase the overall return, because that's what it's all about. Now, today we're going to hear from Jabir Sardharwalla, who is Skybound's Group Chief Investment Strategist. Jabir has over 30 years' experience in the investment management world and has held a number of positions in investment and advisory companies. For Skybound Financial Planning, he acts as our economic strategist, but the responsibility for our advice and recommendations continues to rest with us in Poole, as we are the FCA authorized financial planners. Now, during the seminar, if you have any queries, please use the question button at the bottom of your screens, and those questions will come through to me, and I will forward them to Jabir either at an appropriate point in his presentation or at the end. So I'd like now to hand over to Jabir to give us his views on the current position of the investment markets and the outlook for the global economy. Jabir.
Okay, thank you. Thank you, David. Thanks, Karen. Good afternoon, everyone. I'm just going to call up the presentation. Hopefully, you will all be able to see that. And then I'll just get straight into it. So basically, this is roughly what I'm going to cover in today's presentation. There are quite a few topics there, but I think they're all highly relevant to where we are in the cycle for the UK, because it's often the case that we tend to look at life after an election, but the reality is there's quite a history here, and that history spans a minimum of 5 years. So I think these questions broadly cover that 5-year cycle. It's extraordinary how many different events actually take place within what seems to be a shorter and shorter cycle. So the very first one is what I'm going to kick off with. I just thought to give some context to where we stand before I go into the main theme, which is the budget. And that's spooking everybody right now, quite understandably. I just thought I'd give some context as to how the UK looks. And actually, my conclusion from this is that the UK consumer is in better shape than people might think. We're not normally associated, if you look at the top left chart here, we're not normally associated with actually being a savings nation. If that chart had gone back any further, you'd find the savings rate was actually abysmally low. Lately, and it is quite lately, I mean, it's particularly since the height of the Russia-Ukraine crisis, our savings rate has hit about 10% of disposable income, which, like I said, for the UK is very good. If you contrast that, by the way, with, let's say, our counterparts in the rest of Europe, particularly the EU nations, that figure jumps to 12 to 14%. So it's a huge difference. I mean, it's and that's been consistently high. They are a savings region, but for us, this is actually very good. The the thing to note, though, is that we also, as a country, as a nation, tend to have a much wider balance sheet than our European counterparts. So, for instance, if I was to show you a balance sheet, a typical European consumer balance sheet, you'll find that investments in the markets are actually much lower than what we have. And by the way, we're even lower still versus the US. On the right, you have a confidence index, and you can see that businesses currently lead. Businesses are ahead of the cycle for various reasons. They're always planning minimum 6 months ahead, typically even 12 months ahead. So they are looking at surveys, they're looking at order books, they're trying to understand what overseas markets are doing. And so they can generally read the tea leaves a bit quicker than consumers. But the consumer sentiment there is actually is not that bad. Even though it's slightly in negative territory, it has been bouncing up. If you look at the bottom left chart here, this shows the split of what consumers are actually buying right now. And I always love this. And actually, you can read this in conjunction with the chart on the bottom right. Um, it splits their buying pattern between essential and non-essential items. Another way of putting this is discretionary and non-discretionary. Now, logic would have it, and that logic does apply in other parts of the world. At the moment, it doesn't seem to be particularly applicable to the UK, but I think there are some reasons. It's one of the reasons why the UK is often misunderstood by analysts. In the many years I've been doing this, very, very few analysts have actually managed to get the UK right through to the World Bank, the IMF, etc. You'll find that non-essential spending remains pretty healthy. It fluctuates, but it's all positive. By contrast, essential or non-discretionary items seems to be the area that they're cutting back on. And this chart really demonstrates it. This bit here are the discretionary items. Now, you would have thought that if we're going to cut back, if times were hard and we were going to cut back on anything, it would be that. But we haven't. By contrast, we've actually gone in and cut down on various other areas. It's almost as if this portion feeds that portion. And it's quite interesting, the mindset. I think a lot of that's cultural. People have just come to accept that, we're not going to change our ways. So if you then look at the next slide, if I can turn the page, it is frozen. Oops. Okay, let's try. Sorry about this. It is okay, let's try this. No. Here we go. Sorry. Okay. If you look at the next chart, the critical one is unemployment rates. And our unemployment rate is actually fairly consistent. There's nothing here to suggest that um, that the government needs to be concerned. It's certainly something that the Bank of England looks at when it sets rates. And this is despite the fact that we've had a big contraction in the market as a result of something like 2 million people who are long-term sick. A lot of these are connected to COVID days, but it actually goes beyond that. 2 million from the workforce. It's a lot. And on the right-hand side here, the top right chart, what we've got here is the ratio that compares excess demand for staff against unemployment rates. And the picture here is that the availability, the demand for staff compared to the staff that are available is actually sort of pretty flat. It's in the slightly negative territory, which is why the Bank of England's not particularly concerned on the unemployment side, but it's not really, it's not dropping like a stone into negative territory. The green line here is represented on this side. So the more negative it becomes, the worse it is. It's actually flatlined here. This is the one, the bottom left, that the Bank of England focuses on. It's the change in pay year on year. And that's high. That's currently sitting at around 5% year on year. So you've got two lines here. The dark green line compares the change of the last 3 months compared to the annual, and the light green, the change in the 3 months, the last 3 months over the previous 3 months. This is consistently high. And what you have here is that on the private sector side, it's a similar story. The private sector is actually driving a lot of it. Until now, the public sector was the area that was being compressed. So how does that then compare in terms of the inflation picture? The latest inflation reading shows that we came in at 1.7% year on year. If you take the breakdown of that, the main driver was in the transportation category. And strip out energy, which has been the main reason for why headline inflation has been coming down. And you're actually left with the core inflation rate, which is still quite sticky. That's the blue line. That's 3.2% year on year. So this is the challenge the Bank of England has. Because when it looks at this, it says, okay, which bit of the inflation index is actually affecting people? And I showed you on the previous chart that wages are going up at roughly 5% per annum, which subtract inflation, you're still left with 3.3% in real terms. That's real spending growth. And this is the one key area that the Bank of England focuses on. Sorry, I don't know how to get rid of this. I think that was from the previous chart. Just bear with. If I find a way, I will get rid of it. I think that's from when I was just drawing it earlier. So this really now comes into the whole borrowing picture, because we've got the budget coming up. And this is the main concern. So under the previous government, this is all prior to Labour coming into power just recently back in July. What was happening is that overall borrowing was actually coming down, as you can see there. Sorry, it was coming down. The forecasts show, if you look at it now, between 2024 and 2028, the OBR is forecasting that total debt is going to rise by £323 billion. Overlay that, a forecast done by Lloyds Bank, which is remarkably accurate, actually. They have been in the past in terms of their predictions. They're saying there's going to be an additional 80 billion that's going to pile in on this. So what this is boiling down to is the way fiscal rules are being interpreted. Under the previous government, under the Conservatives, they followed two hardline rules. They looked at public sector net debt, excluding Bank of England's projections, and public sector net borrowing. And to the right here, what you have is Labour's new definitions that they're going to follow. And there's an intense debate around this because it affects the choice of the debt measure and the available headroom that is available to the government in terms of what they can do. And that's reflected in this chart here. Under the Conservatives, it was about 9 billion. When you add into that the new definitions based on, and you can see there are like 4 different classic definitions. Suddenly, the additional headroom for alternative debt measures rises by some very substantial amounts. And this is actually what's spooking markets. They're now saying, how is this actually going to be spent? And this is an example of what is going to actually happen. So we already know about the public sector pay increases. So this is, the rail workers, the nurses, the junior doctors, and so on. That's already almost £12 billion. Then there are other spending increases. These are largely departmental spending figures, which have already been announced by the previous government and which are, to an extent, set in stone. So we know from the numbers that this is what we can expect. The total of those two comes to this, nearly 22 billion. Against that, we can offset certain announcements that they've made. For instance, the winter fuel benefits, the VAT on private schools, and a couple of others, basically smaller ones. That leaves a gap of around 16 billion or so. And it just seems to be rising. If you therefore look at, just to sort of sum up the overall funding picture, what you've got is this. So currently, based on revisions to the economy overall, it was previously very small. It was just about 8 billion or so. That was very manageable. Now throw into the mix all the public sector pay awards. So that's not just the increase that they've agreed to, but this is the increase that is linked to inflation of sorts. It's massive, 63 billion. You can see now why the previous government was incredibly hardline and tight about pay increases and why they just constantly went toe to toe with the unions. It's a huge increase here. And then there are various other known spending items. So, inflation linked departmental spending. Throw into the mix the known savings. So, for instance, the last Chancellor, Jeremy Hunt, announced various things. It was a bundle of things, in fact. But for instance, the tax thresholds, add all of those up and you've got savings here. What you're looking at is a figure. All of these come to a net increase of £60 billion. That's the overall deterioration in the budget over this 4 to 5 year period that's coming up. And that's what's spooking markets. Plus, we do know that Labour would like to invest a further 21 billion to generate growth. Now, any kind of borrowing, any kind of spending on growth is always a good thing. In fact, I would argue, I just came off a call earlier where the trend now across the globe is to start spending money on creating and generating growth. How it's done is a whole different ballgame, but that's the whole objective. It's almost like we've come to a cycle where we have run out of growth and we've been in this mix for some time. That means the government's got to find a total of 81 billion over this time frame. It's a hell of a lot of money. So what are the options? Now, I'm going to give you a very abbreviated view, but here are some thoughts on it. This is courtesy of Lloyds Bank. I've got my own thoughts of other things that they can do. I think the popular ones are here. It's in this pension tax bracket. That's where they can save the most money. The black hole figure seems to be rising all the time. We started with 16, then it got to 22. The latest figure I've now heard is 40. Since then, it's dropped back down a bit to about 30. I think broadly speaking, we're looking at somewhere between 20 and 30 billion. That's what they've got to plug. And besides this category here, there's not much else they can really do because they've come into office on a pledge that they're not going to tamper with income tax rates. They promise not to meddle with corporation tax. But the devil's always in the detail because when you look at the wording, what they've said is we won't meddle with income tax. They've also promised that they won't touch things like national insurance, but they never really specified which component of national insurance we're talking about. The latest gossip is that and which they haven't ruled out, is that they might increase employers' NI. If they do that, it's not going to be very comforting for UK corporates who are already, going to be facing higher taxation rates anyway. If now they've got to pay more in terms of employers' NI, that's going to be painful. In a global marketplace where you've got Ireland next door and the tax rate is something like 12.5% or so, it becomes particularly challenging. So to fill whether it's a 20 billion, 30 billion, 40 billion pound hole, it's going to take a lot more than just hammering non-doms, school fees, capital gains tax, pensions, and anything else. Look at most of these figures. They're pretty small. So they need some hefty moves. They can get a lot of it, I think, from doing something about the tax relief on pension contributions. A big slug of that actually comes is for the benefit of the additional the higher rate and the additional rate taxpayers. They could maybe go for that in one go and try and deal with it. I also think that this budget is going to be front loaded. In other words, they'll try and get the worst of it out of the way on 30th of October. And then just try and sort of almost do nothing. They come in having lost the moral high ground because I'm sure you've seen all the scandals that have been flying around in terms of the campaign contributions and all of that. It's a tough one for them to now constantly go around blaming on the previous government, particularly in terms of those moral areas. That's a really tough one. So what does that mean for markets? What this chart is basically showing is the volatility of gilt yields, gilts being UK government bonds. The government wants to finance any borrowing, it's got to borrow. That debt has a yield, and that yield will fluctuate in the markets. You remember the whole saga under Liz Truss and what happened there. Yields shot through the roof. That's because markets became incredibly nervous. Thankfully, the Bank of England stepped up to the plate and did what they had to do. But this is already showing that the red dots, which show an upward move in the yields, imply higher volatility. That's essentially what it's saying. The more you go up above this line, the higher the yields. And the higher the yields, the higher the risk. That's what it's saying. And so far, they've already moved. This is comparing the 30-year to the 2-year government gilt market. The Bank of England has actually said that it won't take any action immediately after the budget. They're going to wait. I mean, it's then basically only a couple of months till year end. So they're going to review the situation and start accordingly in the new year. They're going to see how markets react to this. But if they have to step in, they will. I mean, they've done that before. They've done it very well indeed. And there's no stopping them in terms of doing it again. Excuse me. In terms of rates, so this is roughly one interest rate cut out of date. The projection back here was that the Bank of England by year end, on top of the 0.25% rate cut that we've already seen from them, by year end, there would be an additional 2.2. So this is very accurate. I mean, we all know Bank of England, like most central banks, works in, not all, incidentally, but most central banks work in quarter of a point multiples. But this is based on market implied pricing. And it's saying that if the Bank of England was to follow the exact principle of market implied pricing, market implied being something almost like a sort of a betting shop, right? You go in there, what are the odds of this government winning or that government winning? That's what this is saying. They're saying that there is an additional 2.2% rate reduction coming. I don't believe that. I just don't think that's going to happen. This is going back to my earlier point about how people consistently misjudge the UK economy. And those early charts that I showed you in terms of the state of the consumer, and if I'd thrown in the distribution of household wealth across different demographics, you'd see that the UK consumer is not in a dire situation. It could certainly use improvement, and the debt picture has been changed. It has been improving, but they're not in a dire shape. I don't buy a 2.2% cut coming up. Uh, so that was essentially the budget. I mean, I think the problem that we've had with the previous government, which has obviously been embroiled in politics, it's been absolute non-government now for goodness knows how long, 10, 11 years or so. The problem is that they've, I think, become so obsessed with trying to ensure that they don't raise taxes on the one hand, and on the other hand, they keep the government finances under control, that there hasn't been any money left to spend on investment growth. That's been the problem. It's almost like playing one of those machines in a pub, you know, those jukeboxes or whatever, and you've got 20p in the bag and the two lights are flashing either side. It's all or nothing. You can double or nothing. Um, they were too afraid to actually move either side. What Labour now faces is, how do you create growth? Growth is the only way we're going to get out of this. And by this, I mean the debt situation. There are essentially only a couple of ways you can deal with debt. The first is you generate above average growth rates, GDP, in other words. For that, you need investment. To finance that investment, you've got to get the money from somewhere, whether it's tax increases or it's through more borrowing. Either of those are fine as long as it's going towards generating growth. The worst thing you can have is to be doing those just to cut down on your existing debt. That means all roads to nowhere. The only other way you can actually create growth is by cutting down on spending dramatically. And I don't think I need to sort of tell you all the headlines around the NHS, education, leasing side. All of that is set in stone. It would be catastrophic to start cutting back on that. So that's the dilemma. This is the challenge that most governments face, and we're seeing more and more now starting to try and come back and control their finances. The other argument that's often been raised, as you can see there in the headline, is Brexit. And there are still people, particularly those who support membership of the EU, who argue that this has cost us dearly. So I had a look at various, and there's all kinds of literature out there. People have now had time to assess the whole situation. And this is roughly where we are now. And the calculation done by this entity is quite scientific. So what they've done is they said, okay, if we take into account everything else that has happened to our economy and the world economy in general, and rather like a formulae in a quantitative manner, subtract the impact of COVID, subtract the impact of Russia, Ukraine, then by definition, what you're left with must be Brexit. That's highly erroneous. You just can't take that approach. But using that approach, they've come up with the conclusion that Brexit has cost us at this stage in the cycle about 2.5% of GDP. And their reasons and rationale are actually shown down here. If you look at the breakdown, this is how it basically adds up. They're saying that it's cost us in investment, in productivity, and in terms of trade. So what I'm going to do is just go through those and really, because I then thought, okay, this was actually a very good entry point to this whole discussion around Brexit to see if it actually had made any sense. So I started first of all with the GDP projections. And this is where we are. And that little gap here is effectively what you were seeing on that previous slide, the 2.5% difference. And then projecting out, they're saying that it will get to a difference of something like 5.6, 5.7%. It's very dangerous to look that far out. I mean, how can you? You can't. The world is changing all the time. But along the way, you've had two major blows, and that's COVID, and you've had the Russia-Ukraine war. And what this is demonstrating is that the trend line is actually now we are catching up with the trend line despite all these blows. So sorry, there's the trend line. These are all headed up in that direction towards it. What people have done is to misjudge the extent to which COVID has actually impacted the system because we've had to borrow so much that today our debt servicing cost stands at something like 92 billion pounds a year. That's the interest that we're paying on debt. Now, remember, in all those previous years, it was almost free money, almost free money. It was nobody ever stopped to think twice. The tide was in, nobody really wondered what was underneath. Now that the tide's gone out, it's staring us. It's your break-even point just to begin with before you do anything else in terms of running an economy is the interest that you got to pay on the debt. So the previous government obsessed with trying to get those yields down. That was their argument there. Um, if you then also look at the trade argument with the EU, this one I find a bit baffling as well because somewhere here you've got you've got the 2.5% gap that they're talking about. But yes, it did drop. There's no doubt about that. It did drop on both fronts. Here's the trend, the trend line for both imports and exports, but it's actually caught up again. That's the whole point. We've gone through this, and this is where the picture becomes really murky because how do you go about attributing how much of it is due to COVID as well as the whole Russia-Ukraine crisis? What matters to me, what I think is the most significant thing here, is that we've actually managed to catch up, and that's just with the EU alone. The EU relies heavily on its imports to the UK. At the last count, when I checked, the total trade, the total imports from the EU in terms of goods and services is around 900 billion pounds per annum. 900 billion. It's massive. And it's not evenly distributed, which was often a mythical argument that was raised during the whole Brexit campaign, referendum, and so on. It's actually concentrated amongst certain countries, like Germany, for instance, and Holland, also to a lesser extent, France. So those are the powerhouses of Europe. So the fact that we've got back there is actually quite significant. There's another reason as well why I think there's been a drop here. And that's because, do you remember this whole, all the shenanigans over paperwork? Because now we're no longer, the free movement of labor and transport and all that stuff. Trusted trader status, as it was, I think, or something like that. Now our goods have to be checked again. You've got to have all the paperwork. Granted, from our side, we were very, very slow in terms of our preparation. Meant a lot of holdups, and I'm sure you can remember those pictures of Port and all the huge queues of lorries and so on and so on. Today, that's basically been cleared up. There is a final factor as well, and full, full dues to Rishi Sunak for renegotiating the Brexit deal, particularly around Northern Ireland. That was massive. What Northern Ireland was suffering from previously under the Boris Johnson deal, compared to what Rishi renegotiated, it's a whole different picture. So I think a lot of this pickup that you're seeing comes down to a combination of factors here. This is the same chart, but it expresses it as a percentage of our total trade. And our share in terms of total trade with the EU shows that exports generally have been coming down, which means by definition that we must be doing more with non-EU countries. And that's exactly what's been happening. We've signed trade deals with Australia. We've signed a trade deal with New Zealand, with Canada. We're getting ever so close to India, etc., etc. So we've rolled over existing deals as well as signed new deals. The other thing you've got to remember is that we're much more of a service-based economy than a goods-based economy. So when often people, criticize us for the fact that our manufacturing base is pitiful, well, yeah, it is, but that's because we rely a lot more on services and we import more in terms of manufacturing goods. I think that's about to change. It's certainly a case, this is exactly what Trump is standing on, amongst other things, in the US. He wants to reshore American production. In fact, he's willing to lower corporation tax rates for companies that bring manufacturing to the US right down to 15%, which is significant, and I think he'll get it. In terms of imports, they're starting to catch up again. So we're almost getting back to where we were on imports as a percentage. But our exports to the EU are starting to go down. And I think that slack has been taken up by non-EU countries. This is the other one that's always been there. Everyone's going to run away. All the migrants are going to disappear. God, I mean, this was just classic mythical stuff. So the black line here represents all the foreign nationals, EU and non-EU. I mean, does that really look to you like, the numbers are diminishing? They're not. It's the way the numbers are split. The EU portion has definitely come down. And I can give you a ton of factors as to why they've come down. And not everything has to do with Brexit. A lot of it has to do with COVID. Because what happened during COVID, basically, you couldn't go out to work. So a lot of construction dried up, people had to work from home. So now you imagine a lot of EU files who are paying huge London rents, which has always been a problem. And not just London, Southeast, Southwest, and further up the country. Largely the sort of areas where they've come to settle, who are now paying massive rents and they've got no income coming in. It is a fact that a lot of them then thought, well, to hell with this, let's just go back. And in the process, those same countries that they've gone back to have now started to pick up. So they need skilled labor. This was a trend that was already happening before. It just got accelerated during COVID days. Look, you can see where the step down took place here. There are other reasons as well. I mean, for instance, the issuing of the new, I think it's called the European status, if I'm not mistaken, in terms of the EU nationals who had settled here. The Home Office stats show that pretty much the vast majority of them have actually taken that up. So it has definitely slowed down new arrivals because now they're thinking, well, I'm not going to get the same status in the UK that I once enjoyed when it was all part of the EU. But the foreign side of it continues to tick up. My worry, and this is the thing that we've really got to look out for. You've got the likes of Robert Jenrick, for instance, now saying that we must work to a cap at any cost. That's an extremely dangerous thing. You try talking to a small to mid-size engineering firm in the UK who's crying out for skilled labor, electricians, engineers, you name it, and who just can't fill the books because we don't have them. The number of grads who are going into science, technology, and medicine or certainly science and technology is on the decline. Think about those grads who are coming out. By the time they really start to pay dividends, it's going to take 10 years. You can't expect these companies to wait 10 years. We've got to plug that gap. And if we're going to take the attitude that we're just going to put a cap on who can come in, that's crazy. It would be a brilliant way to actually lift our GDP. So the other area, which is critical in an era of digital, is, are we still a technology hub? I then started nosing around at the amount of FDI, foreign direct investment projects that are taking place in the UK. And this chart speaks directly to the sterling, to the dollar, sterling to the euro, sterling to anything rate. You can see this is where we had the referendum in 2016. And after that, it started going down. Then it began to pick up. Then it started to drop again. That's Russia, Ukraine. It's also post-COVID. You cannot blame that exclusively on Brexit. This second chart is actually going to be more telling. This just looks at new projects. And our share is actually on the rise. And if you ask the majority, I mean, I speak to different private equity players and private debt players who are established here in the UK. And one of the main reasons why they find the UK attractive is because it's cheap. I mean, the pound is what, 131 against the US dollar. It was even lower a little while back. It was like a bargain hunt for them. The euro sort of almost, I think, pretty much well, it got close to par, not quite. It is cheap. And I'm going to come on to the pound later on. That'll be my last slide. I'm just a couple of slides away from it. But this has been the main driver. And by sector, look at this. This is comparing what's happened last year versus the decade. And digital technology is where we lead. That's the main attraction in the UK. It's dropped off a bit compared to the average over 2023, but that's a backlog effect from 2022. Look at all these other sectors. It's actually pretty much in front. So there's no sign there over a decade-long period that we're not attracting FDI. Sorry, this is a very busy chart. Don't worry, I'm not going to take you through all the numbers or anything, but there's this lovely index called the Global Innovation Index. I just love the name of it. I mean, I just sort of spelt it out. And what you've got here are two rankings, 2023 and 2024. So the top one here is 2023. We were fourth. We slipped one place in 2024. And that's primarily because of two Asian countries that went up the ranks. On the right, you get a more detailed breakdown that actually shows you how they come to this ranking. And it's actually quite interesting because I did a very quick comparison just by category. And there are a couple of areas, principally two areas, that caused us to drop in the ranking. The first was around infrastructure, where the latest reading, 2024, is an overall score of 55. You contrast that with 2023, where it was 63.7. So that's where it dropped. The second area was business sophistication. And that dropped from, to 56.4 from 58.4. But I won't go through all the individual lines or anything, but if you actually look through this, none of them come down to the fact that we're not producing smart individuals or that we're failing to come out with great innovative ideas. It's particularly around boosting business. That's what they're getting at. So what we can't afford to do is to carry on slipping in this index. We've got to stay up there. So is it a case of glass half full or half empty? When you take into account everything we've just spoken about, that I've gone through, the problems that we've gone through, COVID, Russia, Ukraine, all of that, to actually still rank fourth or fifth in the world in terms of global innovation index is not bad at all. I very much hope and pray that in their budget, the Labour Party come out with some strong measures that really boost this side of life. Because if we don't attract that talent, we're doomed. This is really the heart of it. Last slide. What's the outlook for the pound, given everything that I've said? Well, actually, we start from such a low base. The outlook actually is upwards. Have a look at this chart. Okay, it's courtesy of Goldman Sachs. This compares net non-commercial positions. What does that mean? Essentially, it's a fancy way of saying how are speculators positioned for different currencies. And the pound, they're long. In other words, they own the pound. They're bullish on the pound. That's what they're saying. It's come down a bit here. That's because we've gone through the whole election saga, etc., etc. And particularly with the budget coming up, in a week's time, people are a little bit worried. And you've got foreign speculators here, so maybe some of them are non-doms, who knows? But that's why it's come down a bit. But it's compared to the other two, the euro and the yen, we're ahead of the curve. On the right here, you have the forecasts. Again, courtesy of Goldman Sachs. There's sterling here to the dollar. I always just sort of take the dollar as the benchmark, basically. And what they're saying right now, we're looking at around 131, give or take. Over 3, 6, and 12 months, they see it going up to about 140. That's a 7% increase on a 12-month basis. Now, it can be way higher than that. But I think what you're looking at here is a very interesting asymmetric skew in that our downside on sterling is very limited. Yeah, sure. I mean, it could go down. It could go from 131 right now to, something terrible happens. It could get down to 126, 125 even. But at that level, it's not going to make much of a difference. But the upside is huge depending on what the budget does and how much it boosts growth by. And any rise in sterling helps to check inflation because the cost of our imported goods comes down. It's a very powerful tool. That's the other factor that the Bank of England is looking at closely. That's why I didn't believe the prediction about a 2.2% cut in interest rates over and above the 0.25% cut that we've had so far. There are many other factors, but that's a key one. So that was actually the last slide. That's an overview. I'll stop sharing just at this point. But that's my take on the economy. I think clearly everyone's got budget tantrums, understandably. We don't know what's going to come up. We don't know how much they're targeting to raise. More to the point, how they're looking to do it. Starmer's words always ring loud and clear. It's those with the broadest shoulders who have to take the hit. What does that mean? Especially having pledged that he's not going to cut income taxes and all that kind of stuff. So we shall see. We shall find out next week.
Jabir, thank you very much indeed. Very informative. As always, ever more questions to answer, I'm afraid. We've had a couple of questions have come in from the audience. And Mr. L has asked about the promptness of a budget update, excuse me, bearing in mind that there could be so many changes. At one level, I can take some of that because we're going to be sending out our latest quarterly rebalance on the 1st of November, which fortuitously is 2 days after the budget, and equally fortuitously, it will include a complete budget summary of the changes that have been put in place. We'll then consider the magnitude of the changes, and then, depending on their size and their relevance, then we'll look potentially to run perhaps a short seminar just on the budget. But Mr. L, if you can bear with us, there will be something coming to you, considering the postman or woman does their job on the 2nd of November, and then we'll be in touch shortly afterwards. A couple of other questions have come in from a Mrs. M in Shaftesbury. She said, will the anticipated tax rises in next week's budget derail economic growth in the UK?
They could. It depends what they use those tax rises or anticipated tax rises for. That's really the key. If they use it just to try and pay down debt, which, no disrespect, and I'm not trying to take political sides here, but that's not really ever really been a Labour thing. Then I think it could be great for the economy because that means they're going to use it to boost growth. And the advantage of using tax rises for investment is that there is a natural built-in multiplier effect. Quick examples, for instance, I mean, let's say they use it to build houses, as an example. You sell those houses, so people who buy them, and again, it's a question of who gets to buy them. I mean, in the London Southeast area, 1 in 4 buyers of properties are actually foreigners. Something like a similar ratio, if not more, are people who buy to rent, which I've never really sort of considered to be a healthy thing. But the thing with property is that when you buy a property, you don't just sort of leave it at that. What's the next thing you do? You then call in the landscape gardeners. You then call in the furnishers. You know, you do all sorts of things. That's what we mean by the multiplier effect. So your every £1 that you invest in that actually delivers more than that. If that's what they're doing, or if that's what they intend to do, and I've just used one example there, construction. If they take it further afield, take the whole science and technology parts. There's one. A lot of advisors have said, you know, we need something that actually encourages investment in our local markets. We're one of the few nations in the world that really never do anything to support our local markets. We need to work on pension funds to up their allocations to UK markets. It's not a case that the FTSE 100 is truly representative of everything that goes on in the UK, because 70% of its revenue is derived from overseas. It's not really benefiting the UK as such. But if you start going down into the FTSE 250 and beyond, then you are benefiting the UK. So that's what it comes down to answer the question. It depends where that money goes. It'll be short-term pain, but it could be significantly medium-term gain.
Thank you. Thank you very much. There is another question has come in from a Mr. T in Broadstone. He's disappointed that you haven't spent time on the election of the season. So he's saying, what does a Harris or Trump presidency mean for the UK stroke global economy?
Right. Okay. Yeah, it does matter. So the thing with Harris is that, well, it's a couple of things. One is that it's largely the status quo because we've seen what's happened under Joe Biden. So I don't really see a massive amount of change from an economic point of view. I think overall it does boost growth. And that will, you know, of our few exports, quite a bit of that goes to America. So I think that will benefit. Otherwise, you're going to see more inward investment from the Americans. That will carry on. Nothing's going to change. With Trump, it gets a little bit more interesting because a bunch of other factors come into play. He wants to bring back companies to the US. That's going to impact China a lot. But fortunately, we don't really have a reliance on China. So I don't think it's going to have a massive impact, but I think it will improve relations massively. And I think we'll get that all important trade deal done eventually, which was making progress and then stalled when Biden got elected. I think under Trump, that will become re-accelerated, assuming that Trump has forgiven Starmer and his cabinet, you know, for the things that they've called him. So overall, I don't think it makes a massive difference to the UK. For the world, it's a different picture because under Trump, I think the geopolitical risk is, believe it or not, lessened. So imagine this. Trump comes in. You know that Israel's going to have a free hand in the Middle East and they will sort out Iran once and for all. But he's also quite chummy with Putin. And I think he's going to offer Putin an olive branch. And that's what Putin needs to get out of this whole mess. He needs that, which is bad news for Ukraine So the war in that area could come to a halt sooner than people think. Iran gets hobbled, basically, and geopolitical risk after a quick increase starts to subside. Under Harris, it's a different story because I think Harris is going to push hard for a peace treaty, a ceasefire. And I think my guess is that the private words that she's had with Netanyahu on his recent trip probably let him know in no uncertain terms that we'll continue to support you, but you have to work to a ceasefire. And you've got to consider a two-state solution because that's really the only way this can go. And she's committed to supporting Ukraine. So geopolitical risk will rise. If that increases, I do worry about inflation. I think in the back of next year, you could see an upsurge in inflation. Inflation hasn't gone away. As that chart showed earlier, there's a disparity between headline inflation, which is directly the result of energy prices, and they've been coming down, down, down. But core inflation remains incredibly sticky. And it doesn't take much to suddenly see inflation go up again. And that's the overall picture for me. I would personally favor Trump over Harris from an entirely selfish point of view, because I think overall we'll see more things getting done.
Thank you very much. I think we can take a straw poll later as to whether or not Trump versus Harris is echoed across everybody. We've time, I'm afraid, for only one more question, which is from a Mr. G in Winchester, and he asks, is China losing its status as an aggressively growing economic superpower?
Not not as a superpower, no. And certainly aggressively, it's becoming toned down for sure. Um, but not as a superpower. It's an interesting philosophical debate as to what constitutes a superpower. See, I would argue, why isn't Europe considered a superpower? And I think that's because it doesn't have demagogues like Putin, and it doesn't have people like President Xi. And if you put him in that category, Trump, if he should win. Um, Europe's always been mild-mannered and, tame and take everyone's thoughts and feelings into consideration. That for me is the line that divides a power from a superpower. And China definitely wants to make an impression on the world, but right now it's on the back foot. Its economy is in danger of going downhill even further still. It's come out with a raft of new measures to try and kickstart its economy, and it's losing its grip. It would dearly love to displace the US dollar, but it's learned twice, 2008, and then more recently I think it was last year at the BRICS conference, and there's another one coming up, that to displace the mighty US dollar is an incredibly different and difficult thing to do. So that's not going to happen overnight. So no, I don't think it's losing superpower status, but it's losing that bargaining power. You see it in other areas. In the Middle East, what is China doing? Not much. It's not like it can suddenly make a big announcement and say, right, Iran, we're coming to your rescue. They have lost the support of what they thought was going to be an incredibly strong ally in Russia. And then all that went pear-shaped, particularly with the whole Prigozhin saga. China's actually feeling a little bit alone right now.
Right, thank you. Thank you very much. I'm afraid, everybody, we have now formally run out of time. So if you have any further questions, can I ask you to pose them through your own financial planner, and they will make their way to Jabir, and we will respond. This is, as I said, the first seminar we've done. So if you have any feedback, good or bad, please can you channel it through your planners. It's much appreciated either way. On behalf of everybody watching, I'd like to thank Jabir for a very interesting and thought-provoking presentation. Much appreciated, Jabir. Thank you.
Thank you. My pleasure. Thanks, everybody.
Well, thank you all for attending. Goodbye, and I look forward to seeing you all again in the spring as we do our second market presentation. All the very best. Bye bye now.